Sporting goods retailers are struggling. Are kids not playing sports anymore? On this consumer goods edition of Industry Focus. Greetings, fools. Sean O'Reilly here at Fool Headquarters in Alexandria, Virginia. It is April 19th, 2016, and joining me in studio is the Fool's own resident polymath, Mr. Vincent Shen. What's up, Vince? I missed you.
Polymath. I like that. It's a good one.
I've seen your presentation skills. You're good.
How are you? How was your trip home?
It was awesome. I went to the Buckeye State, and it was 70 and sunny every single day. And the week previously, actually, the running joke with my family was we would go to like a Target or a Sam's Club and all this stuff, and there'd still be a pile of snow in the parking lot.
Oh, really?
It was. There were small piles, granted, but there was definitely, and it was just. It's absurd.
Probably gone now after the weather we've had, even around here lately.
But proof positive that jokes about Ohio's weather they're there for a reason. So before we dive into talking about struggling sports retailers, which we haven't touched a ton in the past, but it's a super interesting subject. Wanted to dive into following up on a story that we covered a while ago, which was AB InBev's proposed acquisition of SAB Miller.
Yeah, huge deal, over $100 billion, right?
And you sent this to me this morning, very interesting article in the Wall Street Journal. They accepted a bid, I guess, of $2.9 billion in cash from Japan's Asahi Group for SAB Miller's premium beer brands, which are, and these are the European brands, Peroni, Grolsch, I am totally butchering that. If anybody wants to correct me, it's Grolsch. I mean, I took French in high school, but anyway. And British beer Meantime. One, that's a nice chunk of change. Two, this is just, and what I wanted to highlight was that this is just one of many divestitures that these companies are doing in order to get this deal done.
Yeah, so we discussed, when the deal was first announced, we were breaking that down. We always caveat some of these bigger M&A, these deals that they sign, that there is going to be some stipulations and there's going to be some things that they need to do in order to help increase their odds of regulatory approval. And in this case, obviously, some of those divestitures, this being one of them, I think they received the offer from Asahi probably February or March.
Yeah.
And now it's been finalized. So you mentioned, Japan's eager to expand and get their hands on.
This is their first big acquisition outside of Japan
in some time. Yeah, I think they had previously a pretty big deal, around $13 or $14 billion for like.
Oh, that's right. They bought Jim Beam.
Yeah. Maker's Market, of course. So. As you mentioned, this is one of many. What were some of the other divestitures?
The first thing to go was, of course, this was like a given. This was totally going to happen. Was SAB's SAB Miller's? I think it was 48 or 52%. I do think it was 48%. SAB Miller's 48% interest in Miller Coors LLC, which was their joint distribution venture with Molson Coors Brewing. Ironically enough, they created that joint venture in order to compete more effectively with Budweiser's distribution. Irony is the spice of life, I guess. But that definitely happened already. In March, the company agreed to sell SAB Miller's Chinese beer business to China Resources Beer Holdings. Boy, they really got creative with that name. But that was done in order to gain antitrust approval from the government of the People's Republic of China. It's even after all these divestitures, and all of these definitely need to happen in order to close the deal. The combined entity is going to have 30% global market share of the beer industry on this planet. They're going to have 90% market share, and I saw this list. I mean, there are 190 whatever countries on this planet. They're going to have 90% market share in like a couple of dozen Latin American and African countries. So. Wow. These definitely need to happen in order to, and that's really why they're doing it. They want to match up the South American and the African beer distribution of markets, because those are this century going to see a lot of the growth and GDP growth and everything. This is definitely a long game. So
it's interesting too how just some of these that we talk about the deal itself, over $100 billion. Some of these divestitures themselves are not. They're not small.
This is a $3 billion deal right here.
We
it's
have
just
this
a line item.
Asahi deal, $3 billion, not small by any stretch. And also the Miller Coors, the joint venture you mentioned, that was sold to Molson Coors for $12 billion. And I did not know this until, we started doing some of the research originally when we were learning about CR Snow. That's the number one selling beer by volume in the world. Obviously driven by a lot, if it's popularity in the Chinese market, huge market, right?
Right.
But, that deal was, considering how powerful that is, number one selling beer brand by volume, that deal was only $1.6 billion. So that was generally seen as a very good deal for China Resources. But again, obviously,
we should go get some snow.
I've never tried it. I would
think
like
we need
to.
Yeah.
So hopefully we can try and find it at a store around here.
Yeah, for sure. But yeah, bottom line, this is happening, and I do think the deal will eventually go through it. I kind of like it because they're positioning themselves for another century of growth in all these high growth markets and everything. So, anywho, so before we dive into talking about the world of sports retailing, I wanted to point any listeners out there that are hungry for more foolish content to head over to focus.fool.com, where all industry focused listeners have access to a special discount on the Motley Fool Stock Advisor newsletter. The discount works out to $129 for a full 2-year subscription. Once again, that is focus.fool.com. And Vince, I guess we can let the cat out of the bag, or maybe it's out already, but Industry Focus is now on Spotify.
Yes, I'm glad that you mentioned that. I definitely wanted to bring that up during the show today, at least so our listeners know, because I had not realized until we were talking about this partnership where Spotify was moving into podcasts, and so it's awesome to be on there.
We should play that song "Moving On Up" or something like that. So Vince, digging in here to the world of sports retailing, we're touching on a subject that I kind of noticed just observing the retail world in the last 10 years. But sports retailers are not doing so hot.
All right, so obviously this is one niche of the broader retail space, especially if you're thinking like retail and athleisure wear, which is a big part of these businesses. But I just thought it was interesting because it kind of reflects a lot of the challenges that a lot of retailers are having now. And so we've heard a little bit about these struggling brands, and probably a lot of us are familiar with them. So think for a second about Sports Authority, right? So huge chain. What it was previously the largest sports equipment chain, you can call it, and the product of many acquisitions. It was taken private in a leveraged buyout deal, but they filed for bankruptcy protection in March. They're closing about 140 of their 460 locations, and their current owner is private equity firm. It's Leonard Green and Partners. So they bought
in bankruptcy. Bought the thing.
Oh no! Currently it's owned. They purchased Sports Authority for about $1.3 billion. I think it was about 10 years ago, in 2006. And over time, they've accumulated about $1.1 billion of debt. Usually a pretty common characteristic of these LBOs, and the company has just struggled to operate under that kind of debt pressure.
Right.
So in January, they missed an interest payment, and then since then, they've been pretty actively looking for essentially a white knight buyer to come in and save the company. And though management mentioned that they received a lot of high interest from buyers, nothing really obviously came together. So they're in bankruptcy protection now. So interestingly, for fiscal 2015 that ended January 30th, 2016, the company had revenue of about $2.6 billion. So still, pretty big business. Like I said, 460 locations, but it had before tax losses of $156 million, according to the Wall Street Journal. And there's going to be a 2-part auction. So on May 4th, they have leases for over 100 of their closing stores going up for sale, and then the remainder of the assets, so pretty much everything, potentially go up for bidding about 2 weeks later on May 16th. There's been interest, obviously, from other competitors who are still going. So think privately held Academy Sports and Outdoors, Dick's Sporting Goods, Modell's, which is family-owned, have all kind of talked about the bidding process, getting involved. And so on the one hand, you have competitors who might purchase assets and keep stores open as a going concern. But on the other hand, you have like liquidation firms that might outbid them and just buy it out and liquidate all the assets. So it'll be interesting to see what's left of Sports Authority. It's still a big brand. I'd be surprised to see every single store close.
Yeah, no, that's wild. What's the deal with City Sports?
So City Sports is a smaller example. That actually happened about last October. So they're based out of Boston. Again, just another example. Smaller chain, filed for bankruptcy last year. They closed 8 of their 26 locations, and investors ended up buying out some of their intellectual property. So they're hoping to revive that chain. But in very recent news, and this just happened yesterday, we have Vestas Retail Group. So again, yet another example of like the dominoes falling at this point for this industry. So they operate a lot of big chains that I think people are familiar with: Eastern Mountain Sports, Bob Stores, Sports Chalet, which is out in the West Coast. They are run by Versa Capital Management. So this is a private equity firm. They acquired each of these chains separately and essentially put them under a single umbrella. So they specialize in turning around some of these distressed businesses. So Vestas was formed in 2012 after buying out Eastern Mountain Sports and Bob's, and they added Sports Chalet in 2014. But the thing is, Sports Chalet was already like struggling significantly. They had been in business for over half a century at this point, but they've been scarred by a lot of losses, declining results in the last 12 months. So, they were public, and in their last 12 months as a public company, they reported $343 million in revenue, bottom line loss of $9 million or 64 cents per share. And another big thing is you'll notice is their gross margins, for example, declined from about 38.5% in fiscal 2010 and 2011 to 26.7% by the time the company was
And that,
acquired.
of course, implies they're just having to cut prices in order to move products, which is never good.
So, obviously they're struggling with their operations. So, Sports Chalet's done, and then they're versus hoping to actually maintain Bob Stores and Eastern Mountain Sports. But Vestas CEO Mark Walsh, and I wanted to mention this specifically, he cited online competition and warm winter weather as some of the drivers for the tough times that the different.
I don't buy
brands
that
have
winter weather
experienced.
thing, but
That's more of a one-time thing. So, going bigger picture, those are just some of the examples of the brands or the chains that have fallen victim to this very competitive environment. But let's look at each of these potential drivers, right? So the short-term one that you just mentioned, you're a little bit skeptical about, is the warmer weather from this winter season. Obviously, it's more of a one-time hit, and
it might have been the straw that broke the camel's back.
Exactly.
But yeah.
And the thing is, it was not a small headwind by any stretch. Dick's management for Dick's Sporting Goods, they mentioned that cold weather related categories were down double digits this past winter. So that is not going to help a company that's already struggling.
Right.
So moving on to like a bigger picture, longer term trend, a lot of people will want to just point to an Amazon.com as a reason why these companies have been struggling, right? We know that e-commerce, online retailers have made it tougher and force a lot of retailers to adapt. But I think that's a pretty obvious connection. But at the same time, like if you think about sporting goods in general that these companies are involved in, the internet has really changed how people shop for specialty items. Like if you think about just how in the past, 30 years ago, you might go to one of these stores and the sales associates will be specialists, and they'll be the ones recommending to you, oh, your son should get this baseball glove, or your daughter should get this pair of soccer cleats. It's really popular this season, and they're the experts. But now, everything's online. Think Amazon reviews or just all
this
the different,
baseball glove got 5 stars.
just think about all the different reviews on YouTube and on different message boards, blogs around these different sports and hobbies, and those are the places where you're getting a lot of expertise now. It's just changed where, so 30 years ago you go to the sales associate for that kind of expertise. Now you go to a sports authority, and the only thing they might do for you is check if there's stock in the back. Mm-hmm. So it's just an interesting change in the dynamic. And then another thing is just increased competition from other retailers and the suppliers themselves. So for a company like this, a Sports Authority or City Sports, Nike for example, might be a huge supplier in terms of retail and other equipment, and they have really important relationships with these brick and mortar operations. But Nike's expanded itself into direct to consumer sales. That's like a big growth point for them. So Nike, just as a single example, is generating 23% of their sales now from direct to consumer in fiscal 2015. So that's about $6.6 billion, and that's up 25% over the previous year, and that's up from just $2.2 billion or 13% of sales in 2009. So in that 5-6 year time span, they have triple that number, and that's money that's coming out of the pockets of these other more these brick and mortar retailers. And Under Armour, as another example, they're doing well above 30% of their sales direct to consumer. So here's another example on even their own suppliers here who are kind of making the situation a little harder for them to compete in. And then you also have the last things I want to talk about is specialization. So if you have these different niches within sporting goods, athleisure wear, you might have premium wear, you go to Lululemon. But then if you want just something that's basic, cheaper, and you're on more of a budget, you might just go to a Walmart or Target for what you need. So this the environment for the retailers in this space is really difficult. And so, talking about some of the companies that have struggled, why they've struggled, I also wanted to talk about Dick's Sporting Goods because they're the big dog now. They were previously second to Sports Authority, but they're actually, one of the largest, sports specialty they are the largest sports specialty retailer in the space now. And so they have $7.3 billion in revenue for the most recent fiscal year, and it gives it about 10 to 15% market share for this market. National Sporting Goods Association puts this total market about $64 billion annually. And recently, the company presented at the Bank of America Merrill Lynch Consumer and Retail Conference in March. And during the presentation, funny enough, one of the very first slides is titled Power of Omnichannel. Not surprising at all.
It's like they stole the slide from Macy's or something.
So, keep in mind that the company has had about 39% compound annual growth from 2010 to 2015 for their e-commerce sales. And
so people are going to dickssportinggoods.com and ordering a baseball bat on there.
So some of the things that they're doing well, in 2010, they had $140 million of online sales, so it's about 3% of their top line. By 2015, it's $748 million, over 10% of their top line. So obviously there's that shift in the pie. But also, it's interesting because, he talks about the physical footprint of Dick's Sporting Goods still being a really important piece of their omnichannel strategy. And he says that if they enter a new market or underserved market, a new store opening will usually double e-commerce sales in that region for them. And it has to do with the fact, it's the idea instead of like this, I guess the main thing that they offer now, before it may have been expertise, which some companies still do, right? Like for an outdoor goods retailer, REI is really well known, and they've been able to carve out a niche for customer service. They've been able to carve out a niche for a lot of the sales associates still having
refusing
that
to open
expertise.
up on Black Friday, yeah,
and little things like that. But in a case like Dick's, where a lot of it's commoditized. It's like we want to make sure the consumer can get what they want, however they want it, be it pick up in store, ordering online, going to the store, and ordering through the store if like stock's not there, and just having everything they need lined up to fulfill what the customer or the shopper wants.
It definitely seems to me that the industry at large that we're talking about, it was just a case of there were too many players and somebody had to go. And the winner, obviously, in the situation for the not the high end stuff, but just the guy that needs a baseball bat or glove for his kid, is Dick's. I mean, they're clearly the winner. There's out west there you got like the big five sporting goods and all that stuff, but
which is which appeals also to the discount market as well.
For sure.
So like I said, they've kind of carved out their niche, and Dick's is playing this broader strategy, but they're doing it in a really interesting way. And while these other stores are closing a lot of locations, Dick's has been expanding a lot. They've opened, I think, 200 new locations in the past few years, and I think part of that is expanding that footprint and the fact that it's helpful for them with like shipping to store and become using these locations.
Did you happen to hear what they did with Sears, by the way? I think it was at a Sears location in this is like cobwebs of my mental attic,
I think it was in King of Prussia.
Yeah, King of Prussia Mall, yeah. And they Sears, I guess, partitioned off the second level of a location there, and then they sold a portion of it to Dick's in like a long-term lease or whatever, and that's obviously part of Sears' plans to unlock the value of their real estate. But it's just interesting to see what they'll do with that, if that's a possibility, because then it all of a sudden is kind of like a distribution kind of front retail thing for omnichannel. So real quick, what did you think of a Dick's Sporting Goods, just its valuation right now? It's at 47, trailing earnings of 280. I mean, does that interest you at all?
Well, the thing is, it's surprising for me after reading enough about and doing enough research about the industry, you think that the growth opportunity is not that great. But like I said, they've opened 200 new locations over the past few years, and their current footprint's about 650 stores. Management sees like the overall, long-term potential of at about 1,100 locations. And the thing is, if you compare them to other big box retailers, so to speak, like a Best Buy, they are on the smaller end in terms of their number of locations.
Right.
So they do have that runway, they are really focused on things like e-commerce and driving productivity in those stores. They're bringing their e-commerce operation, for example, in-house to have better control over it and to generate some savings there. So overall, just a really interesting business. And
it definitely seems like they're the current winner or something like that.
Well, the thing
like,
is,
I don't know.
You either look at it that way or you look at maybe not smaller operations in the sense the stores are definitely smaller, but you have a specialized company like a Lululemon, or you have a company like REI or Cabela's, for example, where it's going to be focused more on the outdoors, hunting, firearms, and that being able to carve out that niche and to present that value to the shopper is really important, because otherwise this is just a very intensely competitive space right now.
Cool. All right. Well, thanks, thanks for your thoughts, Vince. Have
Thanks,
a good
Sean.
one.
Appreciate it.
If you're a loyal listener and have questions or comments, we would love to hear from you. Just email us at industryfocus@fool.com. Once again, that is industryfocus@fool.com. And as always, people in this program may have interest in the stocks that they talk about, and the Motley Fool may have formal recommendations for or against those stocks. So don't buy or sell anything based solely on what you hear on this program. For Vincent Shen, I am Sean O'Reilly. Thanks for listening, and Fool on.